Introduction. The Taylor Trading Technique by G.D. Taylor is a classic work focused on short-term market timing, price rhythm, and structured trading behavior. Unlike many modern trading books that rely heavily on indicators and complex systems, Taylor's approach is centered around understanding the natural rhythm of market movement. The book introduces the concept of a repeating three-day trading cycle consisting of buy day, sell day, and short sell day. Taylor believed that markets often move in predictable sequences because trader psychology and institutional behavior create recurring price patterns. His method emphasizes preparation, patience, timing, and disciplined execution rather than impulsive decision-making. The book teaches traders to think ahead, anticipate likely market behavior, and align trades with the market's rhythm instead of reacting emotionally to price fluctuations. This summary explores the key principles, mindset lessons, and practical techniques that make the Taylor Trading Technique a unique and disciplined approach to trading. Section 1. Understanding Market Rhythm. At the center of Taylor's philosophy is the belief that markets move in repeating rhythms. Price action is not completely random, instead, it often follows recurring cycles created by trader behavior and institutional activity. Taylor observed that markets frequently alternate between accumulation, markup, distribution, and decline in recognizable patterns. By studying these movements carefully, traders can begin to anticipate likely market behavior rather than reacting emotionally after the move has already occurred. This approach encourages observation and patience instead of constant prediction. Understanding rhythm helps traders stay aligned with market flow rather than fighting against it. Taylor believed that recognizing these recurring movements gives traders a strategic advantage. The goal is not to predict perfectly, but to trade in harmony with the market's natural cycle. Section 2. The three-day trading cycle. One of the most important concepts in the book is the three-day trading cycle. Taylor divided market behavior into buy day, sell day, and short sell day. Each day has a specific purpose and expected price behavior. On buy day, traders look for weakness and potential lows to establish long positions. Sell day focuses on strength and opportunities to exit long trades. Short sell day emphasizes identifying overextended prices and potential reversals for short positions. This structured cycle creates a disciplined framework for decision-making. The cycle teaches traders to prepare for opportunities before they appear. This forward-thinking approach reduces emotional reactions and impulsive trading behavior. Section 3. Buy day strategy. Buy day is designed to identify favorable conditions for entering long positions. Taylor emphasized buying near weakness rather than chasing strength. Traders are encouraged to look for temporary panic, stop-running activity, or emotional selling that may create low-risk opportunities. The idea is to buy when fear is elevated but market structure remains supportive. This requires patience and emotional control because buying weakness often feels uncomfortable. Taylor believed that disciplined traders must learn to act against emotional crowd behavior when conditions support the setup. Buy day focuses heavily on timing and precision rather than excitement. Entering near favorable prices improves both risk management and trade potential. Section 4. Sell day strategy. Sell day focuses on managing and exiting profitable long positions. Taylor observed that after markets recover from weakness, they often move into short-term strength where traders can reduce exposure or take profits. The purpose of sell day is not necessarily to predict a major top but to recognize when prices may temporarily become extended. This process encourages traders to think in terms of planned exits rather than emotional attachment. Taylor repeatedly emphasized that successful trading depends as much on exiting correctly as entering correctly. A disciplined exit strategy protects profits and reduces emotional decision-making. Sell day teaches traders to think strategically instead of becoming emotionally attached to positions. Section 5. Short sell day. Short sell day is designed for identifying opportunities to sell short after markets have experienced upward movement. Taylor believed that emotional buying and excessive optimism often create temporary price extremes. Traders using this technique look for signs of exhaustion, failed rallies, or overextended conditions. Short selling requires discipline because markets can remain strong longer than expected. Taylor warned against aggressive predictions and encouraged traders to wait for confirmation before acting. This approach teaches traders to respect timing instead of forcing trades prematurely. Patience and confirmation are essential when trading against market momentum. Section 6. The importance of timing. Timing is one of the strongest themes throughout the book. Taylor argued that even correct market analysis can fail if timing is poor. Entering too early or too late changes the entire risk-reward structure of a trade. The Taylor technique therefore focuses heavily on identifying precise areas where probability and timing align. Traders are encouraged to observe intraday behavior, market tone, and recurring price tendencies. This process develops patience and discipline over time. Good timing often creates low-risk opportunities with higher reward potential. Taylor believed that timing separates professional execution from emotional participation. Section 7. Crowd psychology and emotional behavior. Taylor recognized that markets are heavily influenced by crowd psychology. Fear and greed repeatedly create exaggerated price movements that distort short-term value. Many traders buy after strong rallies and sell after emotional declines because they react emotionally to recent price action. Taylor's method encourages traders to think independently and avoid emotional extremes. By studying repetitive behavior, traders can better understand how crowd reactions create opportunities. The technique rewards calm observation rather than emotional excitement. Understanding crowd behavior helps traders remain objective during volatile conditions. Section 8. Discipline and preparation. Preparation is a major part of the Taylor trading technique. Traders are expected to prepare scenarios before the trading session begins. Rather than reacting impulsively during market hours, Taylor encouraged traders to think ahead and anticipate possible outcomes. This preparation improves clarity and reduces emotional decision-making under pressure. Discipline also means waiting for the market to align with the plan set up instead of forcing trades. Consistent preparation builds confidence and improves execution quality over time. Discipline transforms trading from emotional guessing into a structured process. Section 9. Risk management and trade protection. Although the book focuses heavily on timing and cycles, Taylor also emphasized the importance of protecting capital. No trading method works perfectly in every market condition. Traders must therefore control losses and avoid oversized positions. Risk management allows traders to survive periods of uncertainty and maintain emotional balance. Taylor believed that preserving capital creates the ability to take advantage of future opportunities. Controlled risk keeps traders mentally stable during losing periods. Long-term survival depends more on consistency than occasional large profits. Section 10. Developing professional trading habits. The Taylor trading technique ultimately teaches traders to develop professional habits and structured thinking. Success comes from observation, patience, planning, and emotional control. Taylor's method encourages traders to become students of market behavior rather than impulsive speculators. Over time, disciplined observation sharpens market awareness and improves decision-making. The book reinforces the idea that trading mastery develops gradually through repetition and self-control. Professional habits create consistency even during unpredictable market conditions. The goal is to develop stability, discipline, and long-term trading confidence. Conclusion. The Taylor trading technique presents a disciplined and timing-focused approach to understanding market behavior. Taylor demonstrates that short-term price movement often follows recurring emotional and structural patterns. By studying market rhythm, preparing in advance, and respecting timing, traders can improve both execution and decision-making. The book emphasizes patience, emotional control, and disciplined observation rather than prediction or excitement. Ultimately, the Taylor technique teaches traders to align themselves with the natural rhythm of the market instead of reacting impulsively to every price movement. Its greatest lesson is that consistency comes from preparation, discipline, and emotional balance. With practice, traders can develop a calmer and more structured relationship with the market.